Good evening. Welcome to the Shadow Trader Video Weekly for Sunday, November 25th, 2012. The question on everybody's mind probably right now is it real? Is it not real? We had a rally that towards the end of last week that actually straddled a holiday day. A lot of the move happened on Friday, which was a half day, which was interesting. The rally essentially here is real and not real at the same time. I'm going to show you exactly what I mean by that in terms of the market profile. One thing that makes the rally real is that regardless of whether it's made up of short covering or it's just momentum players and it's not real, longer term buying, is how far it goes and how far through technical levels it can run. So after we had the touch of the 61.8 in the markets where I was saying this is where I felt the market would go to, we turned around relatively violently, and instead of backing off right at what would have been a key resistance, I think, right here in the 1400 level in the S&P cash, right? Notice that we actually powered right through it, and the close here on Friday was actually over the trend line. It closed on the other side of the trend line on the SPX. If I show you on the spider, it's really the same thing, right? Right through it. So this is why I feel that regardless of what the makeup of the rally is under the hood, we have to look at how far it's traveled and where it was able to close over key technical levels. And this to me is just really important, that you had this very, very strong support here in the 1400 area of the S&P, which was here and also back here, and then coming back up through it. We didn't resist at all. We just powered right through it. So this leads me to believe that the path of least resistance in all the majors for now is to the upside, and we should be looking for long ideas. I think in the bigger picture, we travel further upwards through the end of the year into early 2013, and then if the poor structure in the profile comes home to roost, then we will see a larger down move that won't just stop after after a correction like it did here to a fib level. It'll go much further, but obviously that would be something that'll be a few months out. So for now, the bet is essentially to the long side. And when I say about the profile being weak thus far, what I'm talking about is the structure underlying here that we've seen in the last few days as we started to rally up. This is a poor high here in the first circle. This is a second poor high. Poor highs are indicative of short-term money kind of trading because they're getting themselves overly long and they're nervous, so they sell when they come to the high, and the high lacks good structure. It lacks excess, like this move down here. That's like an excess low. And here you can see on the Friday, which can be attributed to the fact that it was a half day in the markets possibly, but usually in the profile we just kind of treat everything equal. We look at it over time. Regardless, this is not really great structure. This is kind of indicative of some short covering here at the open, and you have this excess on both sides and very little balance kind of in the middle. So why in the bigger picture why this is poor is what we're not seeing is elongation. Is if the market is going to have longer term money committing to it, you want to see the profiles be longer and somewhat fatter, where you have possibly multiple distributions, where you have buying, pause, buying more, pause, buying more, pause, and you have this more elongated profile. Here we're sort of getting the buying more in like quick bursts, which is indicative of momentum traders and short coverers. So that's what I'm looking at the profile. That being said, remember, however, that doesn't mean that this action here can't continue onward to new highs. Momentum players can certainly carry the market as far as they want. The reason that I'm mentioning it is because it's information that you have to carry forward, because this bad structure always repairs itself eventually. Sometimes it can take a long time. That's why I was saying we could possibly rally through the end of the year into 2013. But if we will continue to make notes and carry information forward, and if we don't see better underlying structure in the market indicating that more longer term money is committed to it, then if there's a break in a few months, that break could be really horrific, because this underlying structure that is poor will come home to roost. So we shall see. All right. Dollar index has cracked towards the end of the week and has completely fallen out of bed here, which has led to the follow-through in the inverted head and shoulders pattern of gold and silver that I was talking about for a while now, which is followed through. So take it over to the GCs. The inverted head and shoulders is this here. Here's your left shoulder. Here's the head pointing down. Here's your right shoulder. You had some nice hammers here. As I was stating on my Twitter feed, I started nibbling on some gold contracts here, okay, and then the ad was over the top here. And now I feel that the path of least resistance for gold is up to retest this level, And if we look at the weekly, I think you'll see this much clearer, is that notice how many times we've had tests of the same price area and failure. It's essentially 1800. 1800 is the key level. It's 1, then it does it again the next week here. That's 2. Then you have 3. These are weeklies, right? So then there's 4. And then look here. 5, 6, 7 weeks here. So altogether, 7 weeks had action where it was coming close, if not touching that same area. And now, after pulling into a higher low, we're moving to test that area again. So to me, the odds are now very strong that a retest of the 1800 is actually going to bring in a lot of buyers here and is going to make the move in gold much higher. This is the, I believe, last gasp here, probably the last leg of this bull move, which I think will culminate in a move to new highs over the 1923 level in early 2013 and push somewhere up to test the psychological 2000, which will only have import, however you want to say it, when prices are below it. And that's important to note. It will only be important when price is around 1940, 1950, because people will be holding out for that psychological level. However, if gold can close above that 2000 psychological level, where I'm sure there will be some mechanical selling, there'll be some responsive traders there trading against the psychological level. But if after those sellers are cleared out, we're able to close above it, then the 2000 number is absolutely meaningless. Then who knows where it can go. Then, will be interesting. That there could easily be, panic buyers, whatever, could take it much higher. We shall see. But anyway, the focus right now, that's going to be a few months away. The focus right now has to be on the 1800. We're at 715.51. I believe just natural technicals just take us to that level, and then it's going to be very interesting to see how we act there. I think that any pullbacks from there are going to be viable, and the break from there should give us a much stronger move to the upside. All right? That's all I have for this week. Again, I hope everybody's having a wonderful holiday. Be safe. Catch you guys next week. Check us out on Twitter. Remember, at Peter Rezicek is the handle. You'll see it at the end of this video. We've been dark all week on Tasty Trade for a little vacation. Tasty Trade show is coming back tomorrow, 2 p.m. Eastern. Shadow Trader Uncovered live only on the Tasty Trade Network. Myself and Brad Agunis, 2 p.m. to 3 p.m. Eastern. We'll see you guys there. All right? Take care. On behalf of myself and the entire Shadow Trader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.